Have you ever wondered what quantitative tightening is and how it affects the economy? Well, today we're going to demystify this intriguing concept. Quantitative tightening, often abbreviated as QT, is a monetary policy tool used by central banks. The main aim? To decrease the amount of money in circulation. Now you might be thinking, why would anyone want less money floating around? It's a valid question, and we'll get to that. But first, let's make one thing clear. Quantitative tightening is essentially the opposite of quantitative easing, or QE, which is a policy of pumping more money into the economy. While QE is like pressing the economic gas pedal, QT is like gently stepping on the brakes. So, in a nutshell, quantitative tightening is all about reducing the money supply in the economy. But, how does it work exactly? Let's delve into that. Quantitative tightening isn't as complex as it sounds, it's all about bonds and securities. Now let's dive into how it works. To understand quantitative tightening, or QT for short, we first need to understand the role of central banks. Central banks, like the Federal Reserve in the United States or the European Central Bank in Europe, are responsible for managing the money supply in an economy. They do this through various methods, and one of them is by buying or selling government bonds and other securities. So, how does quantitative tightening come into play? Here's the deal. Central banks implement QT by selling these government bonds and other securities. But why would they do that? Well, the answer lies in the dynamic of the money supply. When central banks sell these bonds, they're effectively reducing the amount of money in the economy. That's because when people or institutions buy these bonds, they're essentially giving their money to the central bank. So, the more bonds the central bank sells, the less money there is floating around in the economy. This is the essence of quantitative tightening. Now you might be wondering, isn't that the opposite of what central banks usually do? You're absolutely right. This process is indeed the reverse of quantitative easing, or QE, where central banks buy securities to inject more money into the economy. Think of quantitative easing and quantitative tightening as two sides of the same coin. On one side, QE is like pumping air into a balloon, expanding the money supply. On the other side, QT is like letting air out of the balloon, contracting the money supply. So, by selling securities, central banks can effectively suck money out of the economy. But what does that mean for you and me? What are the effects of quantitative tightening? Well, that's a topic for our next scene, so stay tuned. Quantitative tightening can have significant effects on the economy. It's not just about bonds and securities. To understand this, let's think about a classic supply and demand scenario. When a central bank starts selling off its assets, such as bonds and securities, it reduces the amount of money floating around in the economy. This is because the money used to buy these assets is essentially taken out of circulation. With less money available for lending, the natural consequence is a rise in interest rates. Just like any other commodity, when money is in short supply, its cost, which in this case is the interest rate, goes up. This can have a cooling effect on economic growth. Consider a small business owner who wants to expand operations. If borrowing costs are high, they may decide that expansion is too costly and hold off. The same goes for individuals. High interest rates might discourage them from taking out loans for big purchases like a house or a car. This reduction in spending can slow down the economy. But it's not all doom and gloom. Quantitative tightening can also lead to a decrease in inflation. When there's less money in the economy, the value of each dollar increases. This means that prices can stay more stable, and we don't see rapid increases in the cost of goods and services. The effects of quantitative tightening can be both positive and negative, and a lot depends on the state of the economy. If the economy is overheating with too much spending and rising inflation, then a bit of tightening might be just what's needed. On the other hand, if the economy is struggling with slow growth, then quantitative tightening could potentially make things worse. So it's all about balance and timing. Central banks have to carefully monitor economic indicators and make decisions that will guide the economy towards stability and growth. So quantitative tightening can have a big impact on things like interest rates, economic growth, and inflation. But how does it affect financial markets? The effects of quantitative tightening don't stop at the economy. It can also shake up financial markets. You see, when a central bank starts to decrease the amount of money in circulation, this can have a ripple effect on various financial instruments, most notably bonds and stocks. Let's start with bonds. In a quantitative tightening environment, central banks are essentially reducing the demand for bonds by selling them off. This increase in supply, coupled with reduced demand, can lead to lower bond prices. And when bond prices go down, their yields, or the interest rates they offer, go up. This is because the price of a bond and its yield have an inverse relationship. Now, higher bond yields can affect the stock market. Here's how. When bond yields rise, bonds become more attractive to investors compared to stocks. This is because bonds are generally considered safer than stocks, and if they're offering a higher return, investors may move their money from stocks to bonds. This shift can lead to a decrease in stock prices, but that's not all. Quantitative tightening can also lead to a stronger currency. Remember, when there's less money in circulation, each unit of currency becomes more valuable. This can increase the value of the country's currency relative to other currencies. However, it's important to note that these are not hard and fast rules. The effects of quantitative tightening can vary greatly depending on a multitude of factors. These include investor sentiment, the state of the economy, and even geopolitical events. So, whether you're studying finance, investing in the stock market, or just curious about how the economy works, understanding quantitative tightening is crucial. It's not just a tool for central banks, but a key player in the global economic stage. Quantitative tightening is a powerful tool in the hands of central banks. It's a way to control inflation, manage economic growth, and influence financial markets. By selling securities, central banks effectively reduce the money supply, leading to an increase in interest rates. This can have significant effects on the economy, from slowing down economic growth to affecting investment decisions. And that, folks, is quantitative tightening in a nutshell. Remember, it's not just about reducing the money supply, but about shaping the economy and financial markets.